Markets can remain irrational longer than you can remain solvent. While there's some historical question regarding who the author of this saying truly was, it's generally attributed to John Maynard Keynes. Now, during his tenure as the chairman of the Federal Reserve, Alan Greenspan testified many times before various committees in Congress. In front of the Joint Economic Committee, Greenspan noted that markets are driven by human psychology and waves of optimism and pessimism. Bernard Baruch, an exceptionally successful American financier and stock market speculator who lived from 1870 to 1965, identified the following long ago. All economic movements, by their very nature, are motivated by crowd psychology. Without due recognition of crowd thinking, our theories of economics leave much to be desired. It has always seemed to me that the periodic madness which afflicts mankind must reflect some deeply rooted trait in human nature, a trait akin to the force that motivates the migration of birds or the rush of lemmings to the sea. It is a force wholly impalpable, yet knowledge of it is necessary to right judgments on passing events. Greenspan and Keynes are among the most well-known economists in American history, and Baruch, as noted, was an exceptionally successful businessman. Yet they've all come together to realize that markets are driven by emotion and human psychology rather than fundamentals, as most believe them to be. In fact, how often have you heard pundits say that the market is simply not trading based upon fundamentals at this time? These three gentlemen have noted one needs to understand human psychology in order to be able to more accurately navigate our financial markets. So back in the 1930s, an accountant named Ralph Nelson Elliott identified behavioral patterns within the stock market which represent the larger collective behavioral patterns of society. And in 1940, Elliott publicly tied the movements of human behavior to the natural law represented throughout Fibonacci mathematics. Thus, the full theoretical basis for what we now apply as the Elliott wave principle had been fully developed and publicized. Elliott theorized that public sentiment and mass psychology move in 5 waves within a primary trend and 3 waves within a counter trend. Once a 5-wave move in public sentiment has completed, then it's time for the subconscious sentiment of the public to shift in the opposite direction, which is simply the natural cycle within the human psyche, and not the operative effect of some form of news. This mass form of progression and regression seems to be hardwired deep within the psyche of all living creatures. And that is what we've come to know today as the herding principle, which gives this theory its ultimate power. Over the last 30 years, there have been many social experiments that have been conducted throughout the world, which have provided scientific support to Elliott's theories presented almost a century ago. And today, I'm going to be presenting to you my thoughts on the future of the equity markets and metals markets based upon these theories. If there was anyone in attendance here that attended my presentation back in 2016 at the Traders Convention in New York, you were likely taken aback by my expectation that the equity markets were about to start a massive multi-year rally. In fact, for those that may remember, I was expecting a strong rally from the 1800 region in the SPX to 2611 in the SPX, with targets of 2,800 to 3,000 thereafter. Ultimately, we were looking for the market to exceed 3,000 before the bull market, which began in 2009, comes to a conclusion. Yet the most common reason which many who attended that presentation voiced, along with those who commented on my public articles, was that the fundamentals simply did not support such a conclusion back in 2015 and 2016. Therefore, they were all quite certain this was not likely going to happen. So before I go into my current expectation in the U.S. equity markets, allow me to digress a moment and address some of the common thought process of most in the market and why it's often so wrong at major market turns. In an article by Carolyn Baum in Bloomberg entitled "Rear View Mirror is Where Economists See the Future," she termed a forecast based upon fundamentals as a hindcast. I think that pretty much says it all. Within the same article, she quotes Barb Barbera, chief economist at Mount St. Lucas Management Company, as saying, "Allowing the pace of economic growth in the last 3 to 6 months to dictate the next 3 to 6 months beats most forecasts, except when it matters." That's an amazing statement if you take the time to think about it and understand what Barbera was really saying. It means that using backward-looking information, in other words, using fundamentals to attempt to forecast the future, only works within a trend. It will never be able to identify a trend change, which is when it matters. Ultimately, this suggests that following fundamentals is no different than following a trend channel. As long as the trend continues, the fundamentals will seemingly align with the market. But once the price trend ends, the fundamentals are usually still entrenched in the prior trend for quite some time. In fact, in a 1988 study conducted by Cutler, Poterba, and Summers entitled "What Moves Stock Prices?", they reviewed stock market price action after major economic or other type of news, including major political news, in order to develop a model through which one would be able to predict market moves retrospectively. Yes, you heard me right. They were not even at the stage yet of developing a predictive model. However, the study concluded that macroeconomic news bearing on fundamental values explains only about 1/5 of the movement in stock market prices. In fact, they even noted that many of the largest market movements in recent history have occurred on days where there was no major news events. They also concluded that there is surprisingly small effect from big news of political developments and international events. Isaac Asimov once said, "Your assumptions are your windows on the world. Scrub them off once in a while, or the light won't come in." So maybe it's time for us to scrub our assumptions about how the market works. Allow me to present you a basic list of all the fundamental reasons as to why many maintain their assumptions that the market was not supposed to attain the targets we set years ago. As you can see, the list is quite large, and there are still many things I left off. So I have a question for those that have been looking for that elusive stock market crash for the last 2 years as the market has continued to rally. Does any of the price reality of the market over the last 10 years makes you question your thesis about news, fundamentals, real-world dynamics controlling the markets? Well, if you're being honest about seeing the massive rally we experienced after the 2016 elections, when the common belief was otherwise, you should. If you see the markets rally quite strongly after a massive terrorist attack, you should. When you see the metals tank in 2013 after QE was affected, when the common fundamental expectation was exactly the opposite, you should. But no matter how many times investors see evidence that the market is not mechanical or as mechanical as they believe, they simply shrug it off, claiming that the stock market is just not trading based upon fundamentals at this time. The question one has to ask themselves is, if the market continually does not make sense based upon fundamentals, why would you not change your premise to something that consistently does make sense? Lastly, consider a recent study of 2,600 investment recommendations made by technicians and fundamentalists. The conclusion of the study stated, technicians display stock picking skills while fundamentals reveal no value. So let's again take a look at the 2016 chart of the S&P 500 we presented to our members. This is what we presented in 2016. And now let's move on to where I think we are today. Despite the talk of trade wars, we've been looking up to the 3,000 region. Now I'll go into this chart in a little more detail. Effectively, what we are looking for right now is the market to be providing us a pullback into approximately the August timeframe. The depth of the pullback that we see into August will give us indications of how high this rally is going to take us and how long the rally will take us. For instance, if the market is able to break down below 2,700, approach or break down below 2,700 as we move into August, maybe even into September, that is suggesting the market is setting up to rally up to about 3,200 to 3,300 in the S&P 500 and will likely not top until the middle of next year. If the market is unable to break down below, let's say, the 2720 to 2740 region, and all we see is a minor pullback over the coming weeks as we move into August. If all we see is a minor pullback or some type of consolidation as we head into August, that likely means the market is heading up in what we Elliotticians call an ending diagonal. Sounds quite terminal, doesn't it? Well, it kind of is. That ending diagonal, if we're unable to see a deeper pullback going into August, that means the ending diagonal is going to continue moving up in a very jagged fashion. And it's probably going to top somewhere around the 3,000 region. The ideal target we had in our calculations is about 3,011. So generally, that would be our expectation. If we do not see a larger pullback as we move into August, then we're probably going to be going up to approximately 3,011, and we'll probably top out by the end of this year or early next. The thing about the ending diagonal scenario is that when the market completes that diagonal, it will often retrace directly to the point from which it began and quite quickly. That's about the just below the 2,500 region or so. So around the 2,500 region or so. I think that's about where this began. So in the event that we only get the ending diagonal into the end of this year or beginning of next year, you will probably see a very rapid reversal in the market that'll take us back down to the 2,500 region, and it can happen literally within weeks. The question then is, will that conclude that correction? And the answer is no. Once we see the conclusion to this segment of the rally, whether it's the ending diagonal scenario that takes us to 3,011, or the larger degree pullback that then projects us up to about 3,200 to 3,300, the ideal target being about 3,225. Depending on which one of those patterns complete, when that completes, we're looking for a 20 to 30% correction in the stock market. But at that point in time, as you can see, we're still not expecting this rally from 2009 to complete. Rather, we just think that's going to be the standard 20 to 30% correction that we would expect at this point in time. Whereas most people will think the bear market is over, we believe that 20, 30% correction will just be setting us up for the final blow-off top from the 2009 lows. And to give you an example of the price targets we have as potential for that blow-off top, I mean, I have a wave 5 up there. I mean, potentially 4,000, but I will tell you the potential exists for a real blow-off. As an example, the Dow has the potential target around 65,000 as an ideal target for that blow-off top. That means the Dow can potentially double after it sees this next pullback. That's an astounding move, but that's what the larger degree projections are showing. We can get up as high as 65,000 in the Dow once we see that 20 to 30% correction. But ultimately, I think if for those of you that are looking at that big 3 on top, the Roman numeral 3 in paren, if you look all the way down in the right-hand corner on the right side, you'll see the wave 4 in paren. That is the larger degree expectations we have. That once this larger degree pattern completes, which probably will take us into the mid-2020s, we expect a 10 to 20 year correction, or if you would call that bear market rather, that can take us 10 to 20 years and take us all the way back to maybe 1,000 to 1,300 in the S&P 500. So that's the basic perspective we have on the S&P 500 at this time. So let's move on to the metals market. Next one. When we look back at 2011, and we go back to and read articles that were being published back then, it stands out quite clearly how bullish 99% of the market was at the time. And of course, much of it was based upon fundamentals for gold at the time. In fact, one would have to search long and hard to find an analyst who did not believe that it was a certainty that gold was going to eclipse the 2000 mark. Yes, the analyst community got this one really wrong. Back in 2011, very few saw that top coming in the metals market. While our analysts at Elliott Wave Trader were warning investors to exit the market and for aggressive traders to begin shorting, most analysts and market participants were still looking higher while the metals were topping. As we said in August of 2011, again, since we are most probably in the final stages of the parabolic fifth wave blow-off top, I would seriously consider anything approaching the 1915 level to be a potential target for a top at this time. So as you can see, identifying the extreme in sentiment based upon our Elliott Wave analysis performed much better than fundamentals in the gold market as well. Then, 4 years later, on December 30th, 2015, we urged investors to be moving back into the metals complex as we were looking for a long-term bottom to be struck imminently due to the significant bearishness evident in the market. As we move into 2016, I believe there is a greater than 80% probability that we finally see a long-term bottom formed in the metals and miners, and the long-term bull market resumes. Those that followed our advice in 2011 and moved out of this market for the correction we expected are now moving back into the market as we approach the long-term bottom. In 2011, before gold even topped, we set our ideal target for this correction in the 700 to 1,000 region in gold. We are now reaching our ideal target region, and the pattern we have developed over the last 4 years is just about to complete. For those interested in my advice, I would highly suggest you start moving back into this market with your long-term money. As we now know, the market almost immediately bottomed at that time, and we began one of the strongest rallies seen in the metals market history. Now let's take a look at what the GLD chart looks like. As you can see, there are several ways I can potentially count this structure, but what is striking is the size of the pullbacks we've been seeing. Currently, some of the sentiment readings I'm seeing rival the lows we saw back in the end of 2015. The two regions that I'm focusing on right now is the 113, 114 region in the GLD. As long as the GLD holds that support, I'm looking for an impulsive rally that's going to take us through the 118.30 level, which will signal the start of the next move. And it could be a significant move because my expectation is that we're going to that blue box overhead in early to mid 2019. That would be my expectation at this time if we hold 113, 114 on the current pullback. Should we break that 113 support, that opens the door to dropping as low as 105 on the GLD. But ultimately, I don't think much of what we're seeing is suggesting that we're going to see a lower low in gold. While there is a 30% chance we could see a lower low in gold, at this point in time, I think the probabilities suggest that we should be bottoming over the next, could be couple of weeks to as long as month or so, and then we start setting up the next major breakout scenario. So one of our more astute members of our Elliott Wave Trader community once noted that the goal of EW analysis is to analyze sentiment and not to participate in it. So maybe it's time we all begin to understand a bit more about what truly drives the market all the time, and that is market psychology and mass sentiment. If we do, then we can rise above the masses, especially at the most critical times of impending market change. In other words, when it matters. So I want to thank you for coming tonight, and I'm going to open the floor to questions, if anybody has any. Yes, sir.
I couldn't see those charts very well, but you had all sorts of expansion percentages. Can you go over what you use, like the 160, 200, 260, 400?
Yeah, generally, when we are looking for a third wave target, generally, the target is a 1.382 to 1618 extension from waves 1 and 2. That's generally our third wave target. In the metals market, you usually add 1 or 2 to the start of that. In other words, you usually look for 2.618 to 3.618. Metals, because they're a much more emotional market, will often see emotional extremes on both ends of the market. So for those that have ever traded the metals, they know metals move to extremes on both sides of the market. So we go well beyond the standards when we deal with the metals complex. Yes, sir?
Yeah, do you have a similar chart?
Not here. Yeah, I don't have that here. Any other questions? Then I thank you all for coming, and have a good evening.